Look, for global macro and emerging market investors, Vietnam has always been a really compelling story. But that narrative, it's fundamentally shifting right now. Today, we're analyzing the convergence of two massive structural forces: a macro repositioning of global supply chains and a micro upgrade of domestic capital markets. We're moving way beyond the traditional low-cost manufacturing thesis and stepping into an era defined by high-tech evolution and serious institutional liquidity.
So, this brings us to the big question global allocators are asking right now. Is Vietnam truly becoming the next Asian tiger, structurally mirroring the ascent of places like South Korea or Taiwan? Or is the market just pricing this story in way too early? To actually answer this, we need to apply a CFA-level analytical lens to the underlying data. We can't just skim the surface. We've got to really examine the mechanics of the market.
And that leads me to what I like to call the iceberg model. Most investors see Vietnam as a factory story, but overlook the capital market story behind it. The physical factories, the shipping ports, that's just the visible tip of the iceberg. The real structural value, the engine that's actually going to drive long-term valuation re-ratings, lies beneath the surface, in the modernization of its financial infrastructure and the massive influx of foreign institutional capital.
Take a look at this number, 8%. This is Vietnam's highly ambitious target for GDP growth. But there's a really fascinating tension here. Hanoi has a strict political imperative for high growth to reach its 2045 vision of becoming a developed, high-income nation. On the flip side, international institutions are forecasting a more cautious, though still robust baseline. Bridging that gap requires high credit and high investment, and that makes our analysis of where that capital is actually flowing absolutely critical.
So here's our roadmap for this explainer. 1. The new Asian tiger. 2. Moving up the value chain. 3. The capital market catalyst. 4. Where the capital flows. 5. Execution risks and challenges. And finally, 6. The core investment insight. All right, Section 1, moving up the value chain.
You see, the old Vietnam was defined by textiles, cheap labor, and basic assembly. It was a pure cost arbitrage play. But the new Vietnam, particularly clustered up in the northern electronics corridor around Bac Ninh and Thái Nguyên, is characterized by semiconductors, artificial intelligence data centers, and advanced digital infrastructure. It's heavily mirroring the early ascents of South Korea and Taiwan. We're even starting to see autonomous vehicles and industrial humanoid robotics entering their manufacturing portfolio. It's a massive leap.
And look, this isn't just government talk. The world's largest tech conglomerates are putting serious capital on the table. Samsung is deploying over $4 billion into semiconductor packaging and testing. Foxconn is investing heavily in Bac Giang and Bac Ninh, literally expanding beyond Apple assembly to introduce humanoid industrial robots to its product lines. Plus, there are massive commitments from players like Intel and Amkor in the semiconductor space. Oh, and we're seeing landmark partnerships like the NVIDIA FPT Alliance to build out state-of-the-art AI data centers. Which leads us to this staggering figure, $11.6 billion. By late 2025, Vietnam had secured 174 foreign-invested semiconductor projects representing this exact amount in registered capital. This is a foundational shift from basic assembly to true indigenous capability, and it's completely setting the stage for a much deeper, more robust technological ecosystem.
Which brings us to a defining strategic nuance. The important question is not whether Vietnam can become another Asian tiger, but which parts of the value chain Vietnam can truly own. Will it just forever remain an outsourced packaging hub, or can it successfully pivot into high-margin design and proprietary manufacturing? The answer to that question is what will ultimately dictate the long-term earnings power of its corporate sector.
Moving on to Section 2, the capital market catalyst.
This timeline, it is literally the single most important catalyst for Vietnamese equities right now. Following the March 2026 interim review, FTSE Russell formally confirmed the roadmap to upgrade Vietnam from frontier to secondary emerging market status. The inclusion kicks off in September 2026 and wraps up in September 2027. And looking a bit further out, the government is aggressively targeting an MSCI emerging market upgrade by 2030. All of this was made possible by critical regulatory reforms, specifically Circular 08, which finally eliminated the pre-funding requirement that had been blocking foreign institutional investors for years. Now, to actually manage this transition, FTSE Russell is using a 4-tranche phased implementation. Why? Well, because the anticipated capital inflows are just enormous.
A phased approach guarantees market stability, it manages liquidity, and it allows the non-pre-funding mechanisms to naturally absorb the shock of billions of dollars simultaneously rebalancing into Vietnamese equities.
Section 3. Where the capital flows.
So, who actually benefits? Let's break it down into three main buckets. First, industrial parks. These are the physical landlords capturing that massive wave of high-tech FDI we just talked about. Second, technology and telecom companies. They're the ones building the digital backbone. And third, financials. The banking and securities sector will be the immediate conduit for an estimated $1.67 billion in pure passive ETF inflows from FTSE trackers alone. And the primary absorbers of all this liquidity are going to be the index heavyweights. We're talking about massive blue chips like Vinhomes, Hoa Phat Group, Masan, and top-tier banks like Vietcombank. Because when a market is upgraded to emerging status, global capital allocators don't go buying up microcaps first, they buy the highly liquid blue chip leaders to track the benchmark. This dynamic creates a powerful, sustained, re-rating momentum for these specific VN30 constituents.
Section 4. Execution risks and challenges.
Now, it's not all smooth sailing. There are three systemic hurdles we are monitoring very closely. First, power infrastructure. The northern industrial zones have definitely faced grid constraints, and energy-intensive high-tech manufacturing requires absolute, unquestionable power security. Second, talent scarcity. Vietnam is aiming for 50,000 semiconductor engineers by 2030, but right now, the talent pool is still pretty shallow. And finally, perhaps most critically, the risk of capital misallocation. The government has to ensure that high credit growth flows into productive infrastructure, not into speculative real estate or shadow banking, so they avoid repeating mistakes of the past.
Finally, Section 5, the core investment insight.
If you take just one thing away from this explainer today, let it be this. Vietnam's opportunity is not just cheaper labor, it is the convergence of supply chain relocation, industrial upgrading, and capital market reclassification. This exact triad is what's fundamentally altering the discount rate and the terminal growth assumptions for Vietnamese assets moving forward.
For my viewers who follow our deep dives closely, you already know my philosophy. Đừng chỉ nhìn HPG như một cổ phiếu thép, hãy cùng Liêm đọc câu chuyện phía sau dòng tiền, công suất và tham vọng công nghiệp, nơi cơ hội đầu tư thật sự bắt đầu. Simply put, don't just look at a company like Hoa Phat as a steel stock. You have to look at the cash flow, the industrial ambition, and the story behind the numbers, because that is where true alpha is generated.
So, to lock in everything we've covered, here is the LIEMPT core summary. Memorize these 5 hero numbers. The 8% GDP ambition, $11.6 billion in semiconductor FDI, the immediate $1.67 billion in passive ETF inflows, Samsung's $4 billion plan, and the urgent need for 50,000 engineers. Your prime opportunities lie in industrial parks, tech, and financials, provided you actively manage those downside risks of power constraints, talent gaps, and capital misallocation. The global capital flows are shifting, and this institutional window is opening up right now. Make sure you are positioned before the broader market fully digests this transformation. Subscribe to LIEMPT Core Investing, where we decode the bigger story behind Vietnam's rise. The Asian tiger is waking up. The real question is, are you priced in? Thanks for watching, and I'll catch you in the next explainer.